So, ladies and gentlemen, thanks for coming to the webinar. This is the first one of 2018 for NWIDA, for the National Wireless Independent Dealer Association. Normally these are for NWIDA members only, but with such an important topic and one very recent, we decided to open it up. Before I introduce Nick and get into the heart of the presentation, I just wanted to give a little brief on NWIDA. We were formed last year by 4 wireless industry veterans. Each of us has about 30 years experience in wireless. And we are here for the wireless dealers, not for the carriers, not for the big box stores. And as you can see by the 4 cubes on the screen, this is what we provide to our members. Save up to $3,500 a year on products like payroll processing, credit card processing, security cameras, accounting services, everything from basic bookkeeping to full-blown hiring your CFO, disability insurance, a lot of back office stuff. We provide exclusive content, just like the webinar you're watching right now. We are a voice for the industry. We've teamed up with associations like repair.org to help push right to repair legislation, which is currently being talked about in 17 different states. And we manage the list, and the list is simply a wholesale database of phones, accessories, parts. Anybody can be listed on there. If you're a wholesaler, if you're a retailer, you can go on there, use it anytime, get a list of wholesalers that are available, and the NWIDA members are allowed to leave reviews for each of the companies on there. We'll talk a little bit more about NWIDA towards the end. Like I mentioned, we have 3 poll questions. But for now, I'm going to hand it over to Nick Magone, who is the principal of Magone CPAs, and he's going to take you through the seminar.
Thank you, Adam, and thanks for the opportunity to share this update on the new tax law provisions, which will be in effect in 2018. So I look forward to taking everyone through this. If there are questions, you might be able to put them up in a chat box, and I'll see about getting answers to those questions.
We'll do that at the end.
At the end. Okay, excellent. So with that said, there have been many changes. Most of the changes are effected after 12/31/17, and they are temporary. They're set to sunset in 2025, primarily as a result of the Senate rules. The Senate was not able to garner 60 votes, and as a result of not garnering 60 votes, they had to sunset these provisions in 2025. So that pretty much means that for the next, up until 2025, we're dealing with this version of the tax law. No one really knows what we will be dealing with in 2025, and it will be based on who's in office, who's controlling, and all the usual things that we're accustomed to seeing in a little bit of dysfunction in Washington. A lot of the law as it was written in its rush to get out, there are some aspects of it that are confusing. So, we're fully expecting that, at some point in time this year, we're going to end up with additional guidance, which means that the IRS will take a look at the law as it was written and try and make better sense of it. There might be future legislation as a result, and we still don't know what's going to happen with the states. Will they conform to some of the changes that the federal government has, or will they continue to do their own things? I know in the state of New Jersey, typically does not adopt anything that the federal does, or adopts some and not others. So there are other states throughout the country that have that discretion as well. So here are the basics. We've still got 7 tax brackets. The number of brackets didn't change, but the income ranges did change. And for many of these, for many of the previous tax brackets, it's the same or less, with the exception of one. If you're married filing jointly and you make between $400 and $425, instead of having a 33% tax bracket under the existing law, that went to 35%. Now, in addition, in this version of the 2018, they're no longer a dependency exemption. Now, most of you are familiar with a dependency exemption because you're able to claim yourself, your children, maybe a parent who's living with you. That is no longer allowed. In exchange for that, they have given a higher child tax credit for those of you who have children. And for those of you who are caring for a dependent parent, there's this new $500 non-child dependent credit that you'll be entitled to. Across the board, there's been an increase in the standard deduction. The standard deduction for single people went to $12,000. If you're married, if you're a head of household rather, it's $18,000. And if you're married filing jointly, it went to $24,000. One of the things that everyone made a big deal about is as it was passing through the Senate and through the House, is that the alternative minimum tax would be repealed. Well, this wasn't the case. It's still in effect. The exemption amounts have been increased, but as we'll see later in the presentation, most people will no longer be subject to an alternative minimum tax because two of the greatest contributors to being subject to the alternative minimum tax have now been are rendered non-deductible. One would be the state and local taxes, and the second would be what are referred to as miscellaneous 2% deductions, and most of you would know that based on tax preparation fees, union dues, IRA fees, unreimbursed employee business expenses as an example. We'll go through that in more detail, but these have been repealed, and most likely a good deal of individuals will no longer be subject to the alternative minimum tax. As we move forward, the dividend and capital gains rates remained unchanged, right? The top bracket is 20%, and if there's a net investment income tax applies, it's 23.8%. So basically, they kick in here, 0% for married jointly with less than 77,000, as you can see, 15% if you're between 77 and 479, and if you're greater than 479, the rate's 20%. And that's exclusive of the 3.8% net investment income tax. Itemized deductions. Some of you may be familiar with an overall limitation based on your income. There's no longer a limitation. Medical deduction threshold is 7.5% for 17 and 18. It was 10, and it's going to continue to be 10% in 2019. The mortgage interest is limited to $750,000 of debt. There was a lot of discussion about this 750, and the most important thing to remember is that any debt incurred prior to December 15th of 17 is grandfathered, meaning it's under the old rules, and the $1 million limit would be in place. One of the drawbacks, of course, in the new law, and one of the compromises that they made, was that home equity interest is no longer deductible. Now, keep that in mind if you're borrowing on a home equity line and you're taking it on your personal tax return. Home equity interest is no longer deductible. Doesn't matter when you incurred it. There is no grandfathering of this particular interest. Moving into the next section, state and local taxes. We touched upon it briefly. State and local taxes are limited to $10,000 for real estate or income taxes, whatever the case may be. And the miscellaneous deductions, subject to 2% threshold, they're no longer deductible, as I indicated. So these are some of the miscellaneous itemized deductions that we refer to them as miscellaneous 2% deductions. As I indicated previously, unreimbursed employee business expenses, tax preparation fees, investment fees, hobby expenses, legal fees related to producing income. Well, what does that mean? That means if you enter into a lawsuit, technical, hold on one second. Okay. If you run into an issue where someone is suing you and you're trying to preserve your income, it's related to producing income. Previously, you were able to deduct legal fees subject to this 2% of adjusted gross income. Well, let me give you a simple example. If your adjusted gross income was $100,000 and you had $10,000 in legal fees, you would be able to deduct $8,000. The first 2,000 or 2% of the 100 would be eliminated. You couldn't deduct that. Now it goes to zero. So basically anything that you incur personally outside of a business, you would not be able to deduct as legal fees. And of course we have safe deposit fee and we have gambling losses. So those items are not deductible as well. Here are some of the expired provisions at the end of 2016. The exclusion of discharged indebtedness on a principal residence, right? So there was if you had your mortgage discharged, you didn't have to recognize that in as income. There's a deduction for mortgage insurance premiums rather, and deductions for qualified tuition and fees and credits for qualified energy property. This was not written into the original law. Hot off the presses, within the last week or so, they passed legislation that once again made these provisions applicable for the end of 17. So that's some good news relative to individuals who might be experiencing any of these items. Okay, moving on ahead, this 20% pass-through. This is where most of you as business owners are probably very interested in understanding how it works. There's been much talk coming out of Washington and much talk coming out of the news about what a great deal this is for small business, because you're going to effectively be able to exclude 20% of your net profit from tax. That's basically what it says. So it's not as straightforward. There's definitions for what constitutes qualified business income as an example. Business income, if we were to take a high-level view, is your income less your business expenses. Whatever left over is your net income. It does not include investment income. For those of you who have an LLC or an S corporation, it doesn't include a gain from a sale of assets. It doesn't include any reasonable compensation paid to you as a business owner in the form of wages in an S corporation, or guaranteed payments if you have an LLC. And there's also a phase-out limitation. Now, what I'd like to do is give you a couple of examples, because we've heard a great deal about this. The easiest is if your income is $157,500 or less, then the easy thing to do is to take your net income, whatever that is, let's say it's $100,000, multiply it by 20%, and that's your exclusion. As long as your income, if you're married jointly, doesn't exceed $315,000, that applies as well. So the $157,500 was if you were single or married separate, and married filing jointly would be $315,000. So as long as your income didn't exceed those amounts, the simple computation is 20% of your net income. If you made more than that, because you have a spouse who works or your business is doing phenomenally well, there are various other factors that must be considered. So the way the law reads is it says we'll give you 20%, the lesser of 20% of your qualified business income, or the greater of 50% of your W-2 wages that were paid by the business, or 25% of your wages paid by the business, plus 2.5% of whatever your actual fixed assets, gross fixed assets, provided that they were placed in service in the last 10 years. So long and short, it's not as simple a computation as what we were led to believe by the press and by Washington. It's a little bit more involved. If you own real estate, there's an aspect to the real estate that we must consider. We don't know currently in the law. Rental income, as an example, is not considered a trade or business. So we don't know whether or not real estate will qualify for this 20% pass-through. Now, everything I've read to date seems to suggest that it will be allowed as trade or business income, but it still requires some interpretation and regulations, as I alluded to in the beginning. So you can see it'll take a little bit of planning, and just so everyone understands, you don't have to be an LLC or an S corporation to take advantage of this. You could be formed as a sole proprietorship, might have a kiosk in a mall or a small store, standalone, whatever that may be, and decided that you didn't want to form an LLC or incorporate it as an S corporation. You'd still be able to qualify for this 20% pass-through deduction. Moving on to the Affordable Care Act, the penalty to maintain insurance will be repealed in 2019. In 2017 and 2018, it still remains in effect. And just to let you know that there was an executive order written by Trump in 2016 where the IRS, where you put a moratorium on this penalty, so the IRS would accept tax returns for that period of time, for 2016 tax returns, where you didn't have to prove that you maintained the insurance. But for 2017, based on the way the law is written, you'll have to maintain proof or be subject to the penalty. This is the net investment income tax, and it applies to anyone who makes $200,000 if you're single or head of household, or $250,000 or more if you're married filing jointly. And it's really hasn't been any change. This is 3.88%. It is what it is. But the investment fees that you see are no longer, state tax deductible. Those investment fees were all part of the 2% that we discussed in a couple of slides back. So at this point, net investment income tax is here to stay, but any of your fees, are no longer deductible. The alternative minimum tax, it's basically, for all intents and purposes, you could look at it as a flat tax. The exemption amounts increased, married filing jointly to $109,000. If you're married filing separately, it's $54,700, and if you're single or head of household, it's $70,000. But as I indicated previously, the greatest contributor to most people on the coasts, let's say in the blue states, that made them subject to the alternative minimum tax had to do with your state and local taxes. Your state income tax, New Jersey, New York, California, Massachusetts, and your real estate taxes, which is a big deal here in New Jersey because of how high they are. I know California, as an example, is not as punitive when it comes to the real estate taxes. So you pay it, or it's assessed at the point in time when you purchase. So these items, along with your miscellaneous deductions, since they've been repealed, I'm not envisioning, and most people are not envisioning, that there will be a lot of individuals who are subject to the alternative minimum tax. Some changes to retirement planning. In the previous law, you were able to recharacterize Roth conversions to a traditional IRA. Right? It's been removed. Basically, if you changed your mind about doing a Roth conversion and you wanted to keep it as an IRA, you had until the point in time that you filed your tax return, to file another form in order to do it. All bets are off at this point in time, moving forward. The IRS will no longer allow you to recharacterize the Roth conversion. Once you do it, you're stuck with it. Some of the estate and gift tax changes you can see on the screen. The estate tax exemption went to $11.2 million from $5.4 million, substantial increase. Gift tax annual exclusion is $15,000. That went up from $14,000. And the important thing to remember, most people are going to say, or at least the comment that I encounter the most is, well, my estate isn't worth that amount of money. I don't have to worry about anything. And I just want to put in everyone's mind, if you're a business owner, you need to figure out who's going to purchase your business from your estate so that your family is taken care of. Maybe you have minor children that you want to ensure that you appoint guardians or appoint trustees for money that they would be gifted upon your death. Also, depending on what state you're in, you might have privacy and asset protection issues that you want to cover off. So it's not just the fact that your estate is taxable that governs whether or not you should actually do some planning, but there are other non-financial reasons why you might want to update your documents, make certain that you have the insurance appropriately titled, and depending on where you are, Florida, as an example, they do a lot of planning, estate planning through trusts for privacy reasons. Many of you are familiar or may be familiar with 529 plans. These are for tuition, and they were commonly used for university, higher education. So now, and one of the benefits that they did is that it includes, higher education will include elementary, secondary, public, private, or religious schools. So your contributions to a 529 plan can be used for those purposes. The student loan forgiveness will not be taxable income to a student upon death or total disability. I mean, that was a change that came about because certain loans, certain student loans, they found some problems with that. And ABLE accounts deal with disabled family members. So, the 529 can now be transferred to the ABLE account of a family member. So that's beneficial as well. More individual changes, casualty losses, you can only deduct them from federally declared disasters. Alimony, this is an interesting one, is repealed for divorces executed after December 31st of 2018. Okay, which means that if you sign a divorce decree after that point in time, the alimony itself is not deductible, and the person who receives it doesn't pay tax on it, doesn't include it in income. Moving expenses, this was one of those things where everyone asked, I moved, can I deduct it? Doesn't matter anymore. Moving expenses are no longer a deduction. They've been repealed. And the kiddie tax is moving along on more along the lines of trust and estate tax rates instead of the tax rates of the parents, which means that you're going to be taxed at a higher rate for money that's held in your children's accounts, because within, I want to say a few $1,000s, you're at the top rate, which will be 37% for trust tax purposes, which means that as you're planning for the education of your child, they might want to make some use of a 529 plan because there all of the earnings are tax deferred and can be tax free as long as it's used for higher education. Charitable contribution, they increased the limit from 50% of your adjusted gross income to 60%. For those of you who purchase tickets and have to pay a dollar amount for athletic seats, that's no longer a deduction. There's no longer any exceptions to contemporaneous written acknowledgement, okay? which means that, if somebody didn't acknowledge the donation, if you had a check, if it was endorsed properly, that you might be able to make the argument to the IRS that it was still a tax deduction. It's now mandatory for any contribution of $250 or more that you have to have something from the charity that says that you actually made a donation. State and local taxes, we've discussed this a couple of times. The important thing to keep in mind here is if you have rental property, at that point in time you're paying the taxes on your rental property, those real estate taxes are still deductible without any limit. The limit only relates to your vacation home and principal residence, okay? And it's the combination of income, sales, state and local property taxes, all of the like. At the end of the year, as I was doing some of these presentations, prepayment of the 2018 state income taxes, was an issue. They were allowed if we made the prepayment in 17, as long as it was a 17. If you were making the payment in 18, but it was for 17 tax, it was allowed. And they would also allow prepayments of your real estate taxes, some of the 2018 real estate taxes, so long as they were already assessed and due and owing in 2017, but that's no longer going to be applicable to anyone on this webinar because the time for making those decisions has long passed. You have to plan now to avoid some estimated tax payments and withholding. In other words, what you're going to need to do is to, estimate your income for 2018 so there are no surprises, so you can make the necessary estimated tax payments. Here's, just a list of some of the things that they were proposing a change, but they weren't included in the final bill. You'll see that the Section 121 exclusion was left alone. That's basically the gain on sale of your principal residence. There was a lot of talk about modifying it or doing away with that, but that was ultimately left alone. I don't have much more to say on this except, you can take a look at all of the things that were up for grabs. Depreciation changes. As business owners, this is very important for all of us as business owners. There is additional first-year bonus depreciation of 100% for the property acquired after September 27th of 17. So what does that mean? That means that if you acquire some equipment, machinery, anything of that nature, you can expense 100% of that property, okay? And previously, it only applied to new property. Now it applies to new and used property. Now, part of the trade-off here is qualified improvement property no longer applies. And qualified improvement property represented qualified leasehold improvements and qualified restaurant improvements. These are no longer classified as eligible for bonus depreciation. They can be depreciated over 15 years, and actually, they could be accelerated via the 179 deduction. So you'll see up on the right-hand side, there's an increase in the accelerated depreciation, which is referred to as 179, of up to $1 million. So as long as you put in up to $1 million and you don't put in more than $2.5 million, make an overall spend of $2.5 million, you can benefit by depreciating the actual improvements. So this is an area where if you own real estate, if you need to buy, I don't know, cases or anything for the stores, from that standpoint, this would be a good benefit for business owners. There's a lot of planning tips, choice of business entity, going forward. If you're into charitable giving, there are various strategies. As I indicated to you, estate, gift planning, and temporary, increased exemption. As we're talking about, stock options, these are things that, are apparent. I put it in there. It will not apply to you as business owners, may apply to other people, but there's, planning that needs to be done there. Section 199A is the qualified business income, so we have to really identify how that works within the rules, such as the net investment income tax and the passive activity, which passive activity, as I explained previously, might apply to rental income, because rental income is not defined as trade or business income. So these are some of the areas that you might want to plan around. New business ventures, especially if you're entering into partnerships. There's been a lot of talk about moving into a corporate structure because everyone heard about a 21% tax. The answer on whether or not that would be a good idea is it depends. That's the best answer that anyone can give at this point in time, because a lot of that depends on the nature of the business that you're looking to embark upon. If you're looking to get into a business that has a lot of working capital requirements, where you're going to have to retain a lot of earnings, that might be a good move. If you're not in one of those businesses, then continuing to organize as an LLC or an S corporation or sole proprietor might be, continue to be the best option for you. The planning opportunities is, listen, the more complexity, the more possible the savings opportunities there are. You need to consider evaluating the tax structure. And of course, you should be speaking with your CPA, your tax advisor, to help get you around the various complexities in this new tax law, given your business desires and business goals. So with that, I'm ready to take any questions, should there be any, and I thank you all.